Hola amigos, welcome to the Market Message. I'm your buddy Bill Valentine, here to make you a better investor. Before we get into the topic this month, let's take a look at what's going on in the market through the end of February 2018. So normally I go left to right. Let's go right to left for a reason that I'll explain in just a second. You can see that foreign stocks are still off about 5% for the year, US stocks down 4%. Both asset classes had a little bit of a bump up in February. Commodities were flat in February, down 3% for the year. But the two that I'd have you focus in on are U.S. bonds and REITs. U.S. bonds are now down 2.3%, and if you know anything about bonds, you know that when bonds are down, interest rates are up. That relates to the second issue here, which is REITs. REITs are down 9.5%, down 6.7% in the month of February alone. And that's my topic this month. I want to talk about real estate and I want to talk about REITs. I was doing some investigative work, looking at some data online, and isn't it cool that you can just go online today and say things like, I wonder how many houses sold in the United States last month. Well, that information, of course, is available to you. And this big graph that you're seeing here, this big table, is data from the National Association of Realtors. I know that the numbers are small, and if you're looking at this on a phone, it's even smaller. That's why I kind of highlighted some numbers in three different colored boxes. So what you're looking at here is the total number of home sales. On the left-hand side, we do what's called the seasonally adjusting of the rate of home sales. That's to smooth out things like the fact that homes sell much more in June than they do in December. More home buyers are out there in the summer than they are in the winter. And on the right-hand side, we've got U.S. home sales on a non-seasonally adjusted basis in the U.S. You got the aggregate number in the column that's titled U.S., and then for the four major regions that make up the U.S., both seasonally adjusted and non-seasonally adjusted. Let's start with the red box. The red box shows the column of non-seasonally adjusted existing home sales for the last 13 months. And what you can see is the bottom number. It says 313,000. That's the number of homes that were sold in January. That's the lowest number of all of those, including even last January, which was 319,000. The number below that, which is in a green box, is negative 26.7%. And that's just the difference between January and December. And I would argue you don't need to seasonally adjust the difference between January and December. They're both winter months. The fact that January's sales are down so dramatically, I think, is an ominous sign about what we can expect with real estate going forward. Shifting over to the left, you can see in the blue box the negative 3.2%. That's the seasonally adjusting level. No matter what way you want to slice it, real estate's gotten soft. And the reason real estate has gotten soft, the reason existing home sales have gotten soft, has to do with this next chart. This is a look at, over the last 12 months, the yield on the U.S. 10-year Treasury note. At 2.877% as of today, we're up 40% from the lows of the last 12 months reached in early September. The U.S. 10-year Treasury note is not a mortgage note per se, but it is the most important driver and the closest the closest rate or yield to explain what's happening in mortgages. And so, the fact that the yields are up 40% tells you why real estate's slowing down. So obviously this has two impacts. This has impacts and portends weakness going forward for those either in the real estate field or interested in selling a home. We're kind of switching from a seller's market perhaps to a buyer's market. But from an investment standpoint, which is what we mostly talk about here, you can see this behavior now being reflected in the performance of real estate investment trusts as embodied by the ETF with the ticker IYR, which is a massive basket of all REITs relative to the S&P 500 for the last year. You can see REITs down 6%, the S&P is up about 14.8%. So what's the point here? Well, I usually don't like to do stock tips per se. Sometimes I'll share what we're doing at Valentine Ventures, but you have to make your own decisions. That's not what the purpose of this video is. But I am sharing with you candidly that we've lightened the load in REITs. I don't think you can abandon the asset class. There's four must-have asset classes in the growth side of the equation. If you're invested, you have to have U.S. and foreign stocks. stocks, you have to have commodities and you have to have REITs. But I would be on the very, very light side of REITs going forward. It could be a fine year for real estate, but transactions should be massively slower than they were in 2017 in light of the fact that interest rates are finally coming up. And again, why are interest rates coming up? Because the economy is doing well. So fundamentally, the overall picture is positive. But at the same time, the performance of REITs going forward should be on the weak side. And so therefore, I think now is a good time to be kind of lightening the load. Hey, that's my thoughts for this month. Thanks so much for tuning in. We'll see you back here next month. I'm Bill Valentine.